Cash flow planning and when to look for financing. In most cases, we don't even think about looking for financing until, on some levels, it's too late. It's kind of like a parachute. It's the sort of thing you want to have before you need it. And usually the best time to get it is before you actually need it. In terms of lending, if you look for the financing before you actually need it, you're much more likely to qualify for a better loan with a better rate and just better options overall. And frankly, you're just much more likely to qualify for it. Whereas by the time most companies look, just like most individuals, it's already too late. It's already because we desperately need the money, and the fact that we desperately need the money means that what sits behind that is problems with credit, problems with cash flow, problems with proving all the things we need to be able to prove to the bank in order to satisfy them that we're going to be able to pay off that loan. So this first lesson is going to take a good look at why you should apply for financing ahead of time and how you can actually do the right cash flow planning so that you can look down the road, look through your scope into the future, and determine well ahead of time when it might be time to start looking for financing, because you know well in advance, based on a good cash flow model, when you can see that cash flow might run short. Cash flow planning. When to look for financing. Most of the time you think of the person who's in need of financing, or the business who's in need of financing, as the person or business who's in trouble, right? Because oftentimes, all too often, we wait till then to actually secure financing. Wrong time. As many of you are probably well aware, and likely based on direct experience, the times when you need financing are the times when you're least solvent, which is why the banks are least anxious to give you financing. So the time to line up the financing is when things are going well. Just like you never want to look for a job before, or you never want to leave a job before you find the next one. Something like that. I don't know. All I know is this. The time to get financing is when you don't need it, because that's when you're likely to be in a better position as far as the bank's perspective to be able to pay off said financing. In other words, that's when the banks are most likely to give it to you. So do it in advance. Do some preemptive, line up some preemptive financing. Now, of course, does that mean you should just go willy-nilly and, just get loans all day? No. What it means is you should do some planning. The classic expression that most businesses don't plan to fail, they fail to plan, is true. That's why it's such a popular expression. So if you've worked with me for more than a minute, then you know that I'm a big fan of doing a lot of financial modeling type work, which means looking at something like what we have here on our screen, right? So let's say this is a startup company, and we're starting in September of 2015. I'm looking at the statement of cash flows. Notice I've got an increase to a line of credit here based on $100,000. Well, why did we do that? Let me remove that, and let's get rid of the payments. Because in looking at this startup and looking at the first few months, going back to the statement of cash flows, we're running at a loss, right, which is very normal. And we need to definitely pick up the tab on a $6,000 liability insurance policy, right? So we need to cover that, and we don't have enough from the operating profits because we have a loss to cover that. So that, among other things, it's very typical to need startup capital to start a business. That, in other words, it's very typical to expect to operate at a loss in the beginning while you're lining up the customers and doing your marketing and so on and so forth. The best reason for lining up financing for your business is funding the growth of your business. Nobody who's looking at lending your company money is going to be excited if you tell them you're borrowing the money to pay off other debt, for example. But if you say that you have opportunities that you need cash in order to take advantage of, that's the exact kind of thing behind why a bank or other type of investor would be very excited about lending money to your company, because they know that you'll be able to pay it back. So doing a proper cash flow model and looking down the pipeline to see, when am I going to need financing? When might cash flow run tight? Well, for the accountant who's managing clients' bookkeeping, for example, looking at a cash flow model and understanding your client's industry is critically important to this, because it allows you the opportunity to look ahead and, knowing your client's industry, anticipate when, for example, you might need more cash. Using the retail business, for example, you know that you probably need to stock up ahead of Christmas time. So you know the cycles, you know when the time is going to come that you're going to need some extra cash, so you can stock up on that inventory because you know you're going to be able to sell through it during that holiday season. It's things like that and understanding your client's industry that will help you better serve your client as the accountant or bookkeeper. Another example, And I draw on my own personal experience with this one. Years back, I had a couple of jewelry designer clients who at that time were making jewelry that was mostly made of silver. Well, understanding what was going on in the silver market was really helpful in terms of being able to help my clients maximize their gross profit, because silver prices in those days were extremely volatile. So we were able to take advantage of both rises and declines in the price of silver to help maximize that gross profit. And for that matter, we were able to determine when we might need some extra financing to help stock up on silver during those times of decline in silver prices. These are the kinds of things that enable you to become way more than just that most trusted advisor. You'll be the most valuable resource your clients have ever had. So we go in and we see that cumulatively by the end of the year, not terrible, but not great. Maybe I really need only about 20 or 30 or 50,000, whatever it is. Keep in mind, and we're going to cover this later in the course, that depending on how long you're in business and so on, there's different kinds of loans, and some of them you'll be eligible for, some of them you won't be. In most cases, from my research so far, and I have to double check this before you can quote me on it, by which time it'll be too late anyway, because this video will already have been processed and you'll be watching it long after I said it. But I digress. The point I was making is that in most cases, if I recall, you have to be in business for at least 1 year before you can expect to get any business financing. But I'm sure there's exceptions. The bottom line is this. If you have a good cash flow model in place, which means you've got all of the financial statements projected, then you can plan. You can look ahead and you can see, based on a conservative model, when you expect to see dips in cash flow, when you expect to see cash flow tightening up. And if you can look out 6 months, 1 year, up to 2 years ahead and plan on this or anticipate this, then you can start doing the footwork ahead of time to get the financing lined up so that you don't have to worry about getting it when you need it, because you'll already have it by the time that you do. So we go to a company like Fundera, who, after filling out one application online with them, can in effect feed that information into many applications with many sources so that you can shop around and get the best possible deal on your financing. So we might look for a $50,000 line on our startup company. So as soon as I put in the amount borrowed, back over to the statement of cash flows, now we have some money to work with, right? And even with the loss that we're operating at, we're still going to have a little bit of that, actually a good chunk of that money left over. So that's the point. The point is to do your planning ahead of time and get the financing before you need it. Because if you get it after you need it, it's too late in many cases. Not to mention the stress and everything else that sort of follows behind all that. So now's the time. Look at your business, look at your client's business, and take a look at their cash flow. Put their cash flow model together so that you have the tool in place that allows you to have the vision into the future of what you expect their financial picture to look like, so that you can make the decision well in advance and while you're in a position to be able to pay. Because look at it like this. Banks are more likely to give you financing when your cash flow is good. The first thing they ask for in almost every case is your bank statements. And what do you think they're doing with those bank statements? They're adding up your deposits and they're adding up your withdrawals. And they're trying to see if month over month you're going to have enough money, based on recent experience, to repay that loan, whatever the monthly payment might be. They're also going to ask for your balance sheet. They're going to look for certain ratios. They obviously want to see that you have enough in assets to satisfy your debt obligations, including and especially their own, before they're going to determine that you're creditworthy. So these are the kinds of things that the banks are going to consider, which means that these are the kinds of things that you have to consider on behalf of your clients. So cash flow planning is cash flow modeling. That and the time to look for financing is before you need it. Now, a couple other examples. Based on your industry, you definitely may want to be taking a look at your client's industry or your own and using that as a determining factor. I'll give you a classic example, and I've experienced this firsthand. Over the years, for a period of time, I had a lot of jewelry designer clients for some reason, jewelry manufacturers. Just weird how that works. They all just kind of came in around the same time, totally independent of one another. And in every single case, they were all using a lot of silver in the jewelry that they sold. So at a certain point, I got the bright idea to go and look at the commodities markets and watch the silver prices, so that I was able to go to my clients and say, hey, silver is low, it's down right now, this would be a good time to stock up. Right now, of course, a lot of them said to me, I'd love to take advantage of this opportunity, Seth, but I haven't got the cash. which is a perfect use case for why you would want to employ a product like Fundera, so that when you see that that's happening, or when you know that that could potentially happen because your client is in a business where they're dealing in a commodity that's very price sensitive, then you can line up the financing, get a line of credit in place, so that as you're watching the commodities and you see the prices in silver drop, you can stock up on silver, and that's the silver you're going to use to create your product. And then as prices go back up, you're going to be that much more profitable on the jewelry you sell. So you can really increase profit margins for yourself or your clients by simply thinking a little bit and doing some extra work and paying attention to what's going on in that particular industry. So industry is a key factor. The other thing is, as you're analyzing a client's accounts receivable and accounts payable, you see that their customers are slow to pay them, and that's putting a drain on their ability to pay their own bills. You might want to line up the financing or get that line of credit in place so that you have the working capital needs covered while you're waiting for your customers to pay you. Of course, you should also hound your customers and make them pay you faster, but that's another story, and depending on your industry, that sometimes is or isn't realistic. Another thing to look at is the business cycles, right? You have a client in retail, right? So Christmas time, they're going to want to be able to stock up on inventory for Christmas time, right? For the holidays. So, that's another example of where you'd want to have the financing lined up well in advance of that, because you're not buying the inventory in December. You're buying the inventory probably in the second or third quarter of the year in preparation for the holidays. So again, that's when you need financing, so you can stock up on the inventory that you need so that you have the inventory to sell. Because imagine if you sell through your inventory and you don't have the money, or it's all out of stock on your supplier sides because you didn't take the time to line up the financing so you could buy it well in advance. So business cycles, another really, really important factor that plays into when you want to look for financing when you're looking at certain clients in certain industries. And finally, you have a business that just takes off, right? You're funding the growth of the business is growing fast. Again, when that kind of thing happens, if you have something that goes viral on the internet, and you can never know when these things are going to happen, and all of a sudden you're getting orders in, if you don't have the financing lined up, it's going to be pretty stressful to get it right there and then in order to fund the growth of your business. And what happens if you can't fill orders? People go elsewhere. So that's another reason why it's really important to have the financing lined up in advance. And the moral of this whole story is exactly what I said at the top of the video. The ultimate question: when do you look for financing? The answer: before you need it. That, my friends, is my story, and I am sticking to it. So as always, make sure that you're with me here on everything that I've covered, taking notes. And then in the next lesson, we're going to take a look at business loans, almost everything you need to know. I'll see you there. Now that you have the right platform in place for understanding when you might need to line up financing and having the infrastructure put together such that you can line up that financing well in advance of when you need it, so that, as I've mentioned, you're in the best possible position to get the best possible loan or qualify for the best possible deal in terms of financing. Now we want to take a look, before you choose, at everything you need to know, or almost everything you need to know, about small business loans.